Hello, everyone. Welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at West Cooper. Today, I've been joined by my colleague Mahar Afzal, who's the managing director, and together we will be taking you through today's webinar. So, the topic of today is the changes in the VAT Executive Regulation. So, last Wednesday, a cabinet decision was issued, 100 of 2024. Through this, a lot of changes have been made in the executive regulations. So most of these changes, they are effective from 15th of November, where there's a retrospective application. It has been mentioned in the provision itself, but where no change has been or no date has been given, then it will be this new change will be effective from the 15th of November 2024. So we have seen that 33 of the articles have been amended. And two new articles have also been included in the executive regulation. Now, these 33 amendments that have been made in the article, they are not all major amendments. There are some minor amendments as well. Some place the language has been changed, but the meaning of the provision has not been changed. Of the article has not been changed. Some place the arrangement of the clauses have been changed. Still, the meaning has not been changed, or there is certain minor amendment there. Oftentimes we have seen now that there are certain positions which FTA has taken in the past, and they have clarified through public clarifications or private clarifications when companies have gotten them, or also during audits and reviews. So those they have put in the executive regulations to make it so that there's no ambiguity on that. Um, Now, if you have like always, when we finish a webinar, there's a lot of time people who have joined us, they are asking us for, the PPT or the recording. So, just wanted to let you guys know that, all our webinars, previous, we have done 75 webinars till now, they are all available on our YouTube channel. So the handle is Crest Cooper. Even today's webinar will be available there. So if you would like to go through any, of the previous webinar or today's PPT or listen to the lecture again, you can always go to our YouTube channel. Now coming back to the presentation of today for the changes in the VAT regulation. So like I had mentioned already that all the changes are not key amendments. So we will be discussing the key amendments in detail, and then we will take you through an overview of the other amendments. So the first article which has been amended is Article 1. So they have again changed a little bit of the arrangement of this article as well. So previously there were a lot of definitions here, but they were those definitions which were also, appearing in the federal decree law. So they were like duplicate in both the federal law and the executive regulations. So they have omitted them and they have referred there that, all the definitions which are already there existing in the federal decree law, they will apply to the executive regulation as well. Only one new, definition has been added here, which is virtual assets. So virtual assets have been defined as digital representation of value that can be digitally traded or converted and can be used for investment purposes. So this is like, the pure digital, the virtual assets like the cryptocurrencies, bitcoins. They have excluded the digital representation of fiat currencies or financial securities. Now, fiat currencies are basically government issued currencies, which basically they are not backed by a physical commodity like gold or silver. They are backed by the government who are issuing these commodities. They are still paper commodities or financial securities like stocks, bonds, mutual funds, options, or futures. So these basically the digital representation of these paper, fiat currencies and financial securities, they are not included in this virtual asset. Only the pure virtual assets that can be digitally traded or converted and can be used for investment purpose are part of this definition. We have also seen that they have added another definition here, business day. Now, this definition, this is not a new definition. It already exists in the tax procedure law, but they have brought it in the executive regulation. We know already the business day is any day of the week except for the weekends or any official federal holidays of the federal government, basically. So excluding that is business day. So that's not a new definition. It already exists in the tax procedure law, but it has also brought it back in the executive regulation. They've left there's some more definitions like indirect exports, direct exports, overseas customers, reference to the federal decree law, to the standard rate. So some more definitions have been left there as well. The second amendment which they have made is in Article 2 for the supply of goods. Now, like we said, there are some minor amendments due to how they have changed the wording. So if you can see in the clause 1, it is just a matter of changing the language, has been a little bit refined, and the meaning is still the same. So the process of transfer of ownership of goods or of the rights to use them from one person to another person shall include, for instance, the following: a transfer of ownership of goods under written verbal agreement for any sale; B, a transfer of ownership for a consideration in a compulsory manner pursuant to the applicable legislation. This is exactly the same as it was before, so there is no change. There is no change in clause 2 or 3 as well. They have made the change in Article 2 in Clause 4. So, Clause 4, where they are further telling that what else will be considered a supply of goods, in that the supply of water and a supply of form of energy, that has not been changed, it's still the same. But the supply of real estate, that scope for the real estate has been extended. So, previously it used to say that a supply of real estate, including sale and tenancy contracts. Now they have amended this and made it wider, this definition a little bit, and they have said that a supply of real estate will not only include the sale and the lease, but it will also include the other forms of disposal, which through which transfer of ownership can happen between one person to another person. So we can say, for example, like gift or exchange or foreclosure, trust transfer. So basically, wherever, however, other form where the real estate can be transferred from one person to the other, the ownership can be transferred, that will also be included now. Then, like I mentioned before, the two new articles have been added. So this is Article 3 bis, exceptions of supply. This has been added to the executive regulation. Now, this is basically just a second article with the same number. So it is an article between Article 3 and Article 4. That is why it is known as Article 3 bis. It is placed there in the executive regulation between Article 3 and 4. And here, basically, this new article is according to this article, they have mentioned that exception to supplies will also apply to the transfer of ownership or the right of use of government buildings and real estate between government entities, which will not be considered as a supply now. So if we read the first provision, the following shall not be considered a supply, meaning that it will not be considered for VAT purposes. That number 8, the grant or transfer of ownership or disposal of government buildings, real estate assets, and other projects of a similar nature from a government entity to another government entity. Now, what is a government building, real estate asset, and other projects of a similar nature? They have defined in clause 2. So, if you look at clause 2, it says for the purposes of clause 1 of this article, government building, real estate assets, and other projects of similar nature shall mean the following: government entities' premises, government capital projects, government infrastructure projects, real estate asset utilized and used by government entities, real estate asset allocated and utilized to serve a public utility and for public use, develop government land. So they have defined here that what would be included in this. And it has to be the grant or transfer of ownership or the grant or transfer the right of use, exploit, or utilize of these buildings and of the real estate assets and other projects of similar nature, but from one government entity to another government entity. So this is limited only to government entities and not to other type of entities. And this basically is a very welcome change for the government entities because it will reduce the administrative burden. It will increase the operational efficiency where these transfers are required. Another point to note here is that for clause 1B, they have specifically mentioned, like I said, that some places they have specifically mentioned a date. So here they have mentioned that the grant or transfer of right to use or exploit or utilize the government buildings, the real estate asset and other projects of similar nature from the one entity to the other, it will be including any grants or transferred right of use, exploitation, or utilization as of 1st January 2023. So that is there for clause 1B. So although in clause 2 they have defined, what is these, government buildings or real estate assets and our other projects, but still in clause 3 they have said that, further information and, broader scope with more detail and inclusions that will be coming out through cabinet or ministerial decision later. So we need to look out for this, and more information will be coming. The next provision where the change has happened is Article 5, which is exception to the deemed supply. So we know that the federal decree law has given some exception to deemed supply, and then it refers to the executive regulation to give the actual what is the amount for the deemed for this exception. So here the little bit of the arrangement has been changed. You can see that most of the clauses are same, but a little bit of the arrangement of the clauses have been changed. They have mentioned for the purpose of clause 4 of Article 12 of the decree law, the value of the supply of goods for each recipient within a 12-month period shall not exceed 500. This was there earlier as well, which is 1D. Then they have made a clause 2 where they have put in, the other provision for the output tax payable, and they have clubbed that for the purpose of clause 5 of Article 12 of the decree law, the total of output tax payable on all deemed supplies shall not exceed the following. So an amount of 2,000 for each supply within a 12-month period. This was there existing in the earlier provision as well, but they have added, clarified that any amount exceeding this threshold, it will be considered payable tax. And they have added a new one exception for government entity and for charities, that is the 2B, which is that any amount of 250,000 dirhams for each supplier, that is a government entity. In case the recipient was also a government entity and the supplier is also a government entity or a charity, so within a 12-month period, the supply without charge can be made, and this amount up till this amount 250,000, which basically becomes 5 million, and any amount which is exceeding this threshold, it will be considered as payable tax. So now one thing to note here is that where they have clarified in 2A and B that any excess amount will be considered payable tax, they have not similarly clarified in the clause 1. So right now, the gift which is given from one person to the other person in the past 12 months of more than 500, we are still not clear that the whole amount will be taxable or incremental amount will be subject to tax, as it's not being clarified here. The next article which they have amended is the voluntary registration. Now, voluntary registration, we know that, if taxable supplies or expenses is above 187,500, then a company, they can opt for voluntary registration, whereas mandatory registration is a must to apply. Voluntary, it's on the taxpayers, decision, discretion if they want to go, but they need to have, at least the taxable expenses or supplies which are exceeding 187,500. So there's no change that is made to the clause 1, 2, or 3. What they have done is that they have added a new clause 6B. And in the new clause, they have said that the person may not register for tax voluntary unless he proves to the authority that he is carrying on the business in the UAE and he has intention to make any of the supplies specified in paragraph A, B, or C of clause 1 of Article 54 of Federal Decree Law. So now this 6A was already there. So if you read the old provision of 6, this condition was already there that a person may not register voluntary unless he satisfies the authority that he's carrying on a business in the state. But now they have also added another condition. Both these conditions need to be met. They need to, the businesses have to satisfy, FTA that yes, they will be carrying on the business. They will be making taxable supplies also in the future. Now, those taxable supplies, basically what they're referring to in clause 1 of 54, A is the taxable supplies. In B, they're referring to those supplies which are made outside of the UAE. But if they were made inside the UAE, they would be taxable, or those supplies that are made outside of the UAE. And if they were made in the UAE, they would be exempt supplies. So they're including all of that. So we need to prove, because we've seen that a lot of times the businesses they are taking the voluntary disclosure based on the taxable expenses, and for a long period of time there is no taxable supply. So I think that FTA would be a bit more careful to grant these voluntary registrations now in the future. The next article is Article 14, tax deregistration. So we already know that, the tax deregistration you have to do within 20 days of if you're meeting any of the cases, which are that if the registrant, the business has stopped making the supplies, or if the value of the supplies, they are, below the voluntary threshold. So, the taxable expenses or taxable supplies, if they are below the voluntary threshold in the last 12 months, then you need to go for this tax deregistration. So they have not made any changes to Article 1 and 2, 3, 4, and what they have done is added a new article. They have changed a little bit of the arrangement of the article, but the new article is Article 9, where they said that the tax registration shall not absolve a person from having to comply with the provision of the decree law And this decision, including filing another tax registration application when the taxation requirements are met. So basically what they're saying is that even if the tax registration has been done, still the taxpayer, they will be liable to file another tax registration if they meet the, criteria again. So they start making the taxable supplies, or, again, the taxable supplies are going above the voluntary or meeting the mandatory threshold. So they need to again apply. So just by deregistration, they will not absolve them from any future, compliances under the law. The next article, Article 14 bis, is again, it's a new article. Like we already clarified that this just means that, it is the second article with the same number. So it is between Article 14 and 15. So this is a clause which they have added for tax deregistration to protect the integrity of the tax system. So what they have said in this new article is that the authority can issue a decision to deregister a person if the authority determines that maintaining such tax registration may prejudice the integrity of the tax system, provided that any of the conditions below are met, which is that the registrar no longer meets the tax registration requirements, and the registrar has not submitted an application for tax registration to the authority, or the registrant has initiated a tax deregistration application but has not completed such application, or any other condition specified by the authority. So now, if you would notice, during this year also, a lot of the companies would have received, emails from the tax authorities where FTA is, informing them that, okay, you're, in the last 12 months, you are filing nil returns, or you can go for deregistration. Now, they did not have a formal, authority to do that, to make that decision happen, but they were informing a lot of the companies. Now they have got this formal authority in the law where they can do this deregistration on behalf of those type of companies where you have been filing the returns, let's suppose, for the last 12 months, or there's no taxable supplies, or you stop doing business. And if you're not submitted the application yourself, or you have submitted the application and they're referring to that if there is any, for example, resubmission has come in, additional information is required, and you have not, submitted it again. So in that case, also they do have the powers now. They do need to, in clause 2, verify that the person is not eligible for tax registration. Like, for example, for the next 30 days, you will not again, be eligible for registration. So then, they need to make sure about this before deregistration. Again, they've added the same clause that tax registration initiated by authority will not absolve the person from having to comply with the provision of the decree law in this decision, including filing another tax registration application when the tax registration requirements are met. So again, they're saying that still, even if the tax authority themselves have deregistered you, even if you have not applied yourself, still, if you are meeting the criteria again, you started making the taxable supplies again, or it's gone up above the mandatory threshold, you still will be required to register again. Article 15, deregistration of a tax group registration or amendment thereof. Now here they have clarified in Article 2A that a member of a VAT group will also be needed to be removed from the VAT group, where in addition to the cases mentioned, so we know that the cases where you need to be where you need to be removed if you stop making the supplies. So in addition to that, even if when the member is ceasing to make the taxable supplies, they need to be removed from the group. So we've seen practically that a lot of people, when they've initially made the tax groups in 2018-19, and the members at that time were making the taxable supplies. A lot of times some members are not making the taxable supplies, but they have not been removed from the VAT group. And a lot of time when any amendments are made in the VAT group, we've seen that he has been questioning those members and asking for the turnover declaration for the last 12 months for all the members in the VAT group, because they want to remove those members who are not making taxable supplies. So now they have put this in the law itself in this Article 2A, and has said that they need to be removed from the tax group where any of the cases in the clause 1 have been met, which are where if the person who is registered as a tax group no longer meets the requirement for registration as a tax group, if there is no longer an association between the persons who are registered, as a tax group based on economic, financial, regulatory practice, and if there are serious grounds on believing that the registration as a tax group is permitted to continue. It would enable tax evasion or significantly decrease tax revenue. So in addition to this A, B, and C, basically if the members cease to make taxable supplies also now being added here. The next article where the amendment has been made is the zero rating of the export of goods. Now, the zero rating of export of goods here, a lot of time people have been facing this issue where, exit certificates were not available, and which is one of, FT was treating as one of the conditions of, claiming the zero rating on the export. A lot of time people were struggling because some custom authorities were not issuing, the exit certificates, or they were not stamped. There were a lot of issues. So now this is a welcome change in the new law where they have given some relaxation, or you can say some alternates to the documents that need to be maintained, and also they have defined the official evidence and the commercial evidence more in detail, so that and excluded a wider category there. So if we do a plain reading of this in Article 1B, basically they have said for direct export, and then in the next clause in B, they have in 2B, they are talking about direct export, but in both the places, they have said that the exporter can retain any of the following, which is a custom declaration and a commercial evidence that can prove the export, either this combination or a shipping certificate and an official evidence that prove the export, or in case of the custom suspension, a custom declaration that can prove that the goods have been put into this custom suspension. So these are the three combinations. So any one of these, documents you can keep, and this FTA should allow the zero rating of the export for that. Now, if we come to the definitions, again, like I said, in the B, in 2B, they have also mentioned the same, that overseas customers or the agent can obtain the for any of the following and provide it to the supplier, which is still the same combination. If we look at the previous definition for the official evidence, it simply said that means export document issued by the local emirate custom department in respect of goods leaving the state. And for commercial evidence, they said it includes airway bill of lading, consignment note, or certificate of shipment. So now they have expanded on this, and they have said that official evidence means the export certificate issued by the custom department in the UAE, or it can be a clearance certificate issued by these department, or any other competent authority, in the UAE regarding, those who are looking after the goods leaving the state after verifying the departure from UAE. Or it can also be a document or clearance certificate certified by the competent authority in the country where, the goods are being received in the destination country. So stating that, the entry of the goods into the country. So the real purpose of this is to ensure that the goods have left the UAE. So it can either be the export certificate, which is issued by the custom authorities. If the export certificate is not there, then it's a clearance certificate issued by those department or similar department, or it can also be a certificate which is clearance certificate issued from a competent authority of the country where it is a destination of those goods. Proving that the entry has been made. So that means that they have already exited UAE. For commercial evidence, they have said that it means any document issued by sea, air, or land transport companies and agents, and which can prove the transfer and the departure of the goods from the state to outside the state. And it includes, for in case the goods are being, taken through land, it will include land waybill or land manifest. If they are taken through sea, it will include sea waybill or sea manifest. If they are taken through air, the goods to the exported through air, then it would be air waybill or air manifest. And they have also said that if the commercial evidence is not available, then this shipping certificate, which is a certificate issued by the sea, air, or land transport companies, so this is a certificate which is issued by the transport companies or the agent. So that can be considered as an equivalent of a commercial evidence in case where it is not available. So after reading this definition, if you come back, so they are requiring that either a custom declaration and a commercial evidence that proves the export, or a shipping certificate in case the commercial evidence is not there, and an official evidence where they're given these three options, and then a custom declaration in case of the suspension. So now I will hand it over to Mahar, who will be taking you through the remaining of the articles. for the rest of the presentation.
Hello, Faiza. Thank you very much. And thank you very much to everyone for joining us once again. And as usual, welcome back. A lot of things we have already covered related to the changes in the executive regulation that has been introduced by the Federal Tax Authority. What about the remaining changes that we'll discuss as well? There are changing in the wording relating to the export of zero-rated services. But as per our understanding, we were already doing the same treatment because we know this. There are some general services, there are some special services, general services. We know this. Other than special services, every services fall under the definition of general services, and the special services are services related to the real estate, services related to the catering services, event services, cultural, artistic services, sporting events, transportation, telecommunication services, and transport related services. All these services fall under the special services. And we know that the place of supply of the special services where these services are being provided. If these services are being provided out of the UAE, then we need to look into if these services are being arranged by the party which is based in the UAE, then it will be export of zero-rated services. And if these services are being performed within the UAE, so the place of supply will be UAE and it will be subject to tax in the UAE. So now this is our understanding earlier as well. Now the FTA has clarified in the revised executive regulation that what they have mentioned. This is services that are treated as being performed in the state and in the designated zone, and these services pertains to restaurants, hotels, catering services, cultural services, artistic, sports event services, transportation, telecommunication services, or transport related services. The place of supply of these services will be where these services are being performed, means these services will not fall under the zero rated services. I just wanted to give you an example. The one company in the UAE, that company is providing the services to a customer which is based out of the UAE, but these services pertains to the event which is being held within the UAE, so it will not be considered as an export of services. It will be considered local services and local taxation will be applicable. So this is the changes that has been made in this Article 31 of the VAT regulations. Zero rated for the export of services. There no other change except they've added one reference of the Article 57. Article 57 is the new article in the law, in the basically the recovery of tax by the government entities and charities. The government entities which are subject to tax, if they are providing the sovereign activities, they have a right to claim the input tax. If the charities they are performing the relative services, they have a right to claim the input tax as well. Now they have given the reference of the same article in the Article 31 of the law, and this article is Article 57 of the UAE VAT law. They have just given a reference, nothing more than this. Then the no change here, facilitation of outbound tour packages. It was zero rated earlier and it is zero rated now as well. There is no change in this. Zero rating goods and services supplied in connection with the means of transport. We all know what are the means of transport. Means of transport are aircraft, ship, boat, which has not been designed for the recreational purpose, but it has been designed for the commercial purposes, business purposes, and if the aircraft, ship, these are being used for the transportation of goods and services, goods and passenger from the UAE to the rest of the world or from the rest of the world to the UAE. So these are called basically means of transport. In the means of transport, there's a train, buses as well, which can carry maximum up to 10 people, more than 10 people, and these are being used for the public transport. If these are the means of transport, like Dubai Metro is the means of transport, Emirates Airline means of transport, in the same way, ships are the means of transport, in the buses that is being used in the UAE, but these are being used for the public transport of the people, not for the private transport. These are the means of transport. And supply of the means of transport is where the means of transport are being supplied. Now they have added one more definition. Further, as I mentioned, the import of the means of transport. This is very critical because we know this that the importer is liable to apply the reverse charge on the import of goods. Whenever we are asking reverse charge, means the importer is liable to pay tax on behalf of the non-resident supplier. So means the non-resident supplier was supplying the means of transport in the UAE. If the non-resident supplier was already supplying the means of transport in the UAE, this is a supply and supply of means of transport, then the said law said basically the treatment will be same. Any goods that are being supplied or imported in the course of operation, repair, maintenance of the means of transport, then those goods will fall under the definitions of basically what are the means of zero rated definition as well. So this thing has been clarified. Furthermore, they have added that additional zero rated condition they have added, like services supplied directly in connection with the means of transport. What type of services can be? It can be operating services, it can be repair services, it can be maintenance services, it can be converting the means of transport back to the same condition. The means of transport can be used as a means of transport for the transportation of goods or the transportation of the passengers or the public transport, as the case may be. Those means of transport will be falling as zero rated, and the services supplied directly in case of operating, conversion, repair and maintenance, it will be zero rated. This they have mentioned, and this is important. If you are importing any services, initially earlier we were applying the reverse charge mechanism. Under the reverse charge mechanism, being a customer, we were applying the reverse charge when we were paying output tax on behalf of the non-resident supplier. On the behalf of non-resident supplier, we were assuming the supply that is being made by the non-resident supplier is a standard rated supply. This is the reason we were applying the reverse charge. Now they said if you are importing any services like services of operating, repair, maintenance related to the means of transport, those services will be zero rated as well. And they have further explained the services. You can go to this article: services or maintenance of means of transport, parts, equipment, cleaning and repainting the means of transport, converting the means of transport back to the same condition that the item can be used as a means of transport, it will be zero rated. Then this is a further more clarification is given. I think this is changing in the interpretation as well. Already we were applying the reverse charge mechanism. We were paying output tax, we were claiming input tax. Now they are asking if you are importing any means of transport or are you importing any services directly to the related to the means of transport, those services will be zero rated and you will not be liable to apply the reverse charge mechanism. Financial services, they have added some definition in the financial service. Specifically, they have included the crypto service, cryptocurrency. Faiza has already defined this is what is the basically digital assets. Other than fiat asset, that a digital asset that can be exchanged, then can be converted, that can be invested. Those digital assets, other than the fiat currencies, which have even the digital asset, it will not be falling part of the digital asset. So basically, you can say the cryptocurrency. Now the crypto, they included as a financial services. And furthermore, they have mentioned if you are making any investment of the crypto, or we are making exchange of the virtual asset, or transfer of the ownership of the virtual assets, management and safeguarding any services directly related to the virtual assets, all these services shall fall under the financial services, and the treatment will be based upon the generic principle. Like if these services are being provided to anyone within the UAE, it will be exempt services. If these services are being provided with anyone out of the UAE, then we need to look into this. If this fall under the export of services or local services. If this is export of services, zero rated. Local services, standard rated 5%. Now, important thing is they have mentioned, they have applied these changes retrospectively starting from 1st of Jan 2018. Digital assets, retrospective changes. So if any exchange was there, the buying assets, selling assets, exchanging assets, investing assets, converting assets, all those will be exempt or zero rated. But important thing, if any services are being provided, any advisory is being provided related to these assets, those advisory services will be subject to tax if the place of supply is in the UAE and the person to whom these services are providing, they don't have any, they have the place of establishment or fixed establishment in the UAE, it will be considered standard rated supply. Otherwise, it will be considered zero. It can be considered as a zero rated supply as well. So important thing is they brought the virtual assets officially as a part of the VAT regulations. Now the VAT will be applicable, VAT treatment will be applicable on the virtual assets. So either you are buying, selling, investing, converting, it will be financial services, it can be exempt, zero rated, any services related to that, it will be taxable. It will be effective starting from 1st of Jan 2018. They have highlighted the same thing. The management of the investment funds Basically, might be the fund is there who is managing this, which means service provided by the fund manager independently for a consideration or to fund the license with a competent authority in the state, but not limited to management of the fund's operation, management of investment, foreign on behalf of the fund, monitoring and improvement of fund's performance. All these fall under the financial services. Transfer of ownership of virtual assets, including virtual currencies, these will fall under the virtual assets and financial services. Conversion of virtual assets, financial services, keeping, managing virtual assets and enabling control thereof, these are falling under the virtual assets as well. I've already discussed the treatment. Fund management services, this is the same thing that I've already discussed. Single or composite supply. There is a possibility that if two goods are being supplied or two services are being supplied, one is the principal component, one is a small component. So it will be considered, there is a possibility. It can be single supply, it can be a composite supply as well. So if these two components are being supplied, one consideration is received, and this is being showed as a one item, then we need to show as a one line item on the face of the invoice. If you show a one line item on the face of the invoice, then the tax treatment will be based upon the main item. What is the treatment of the main? I just wanted to give you an example. If you are traveling by air, you are getting ticket, along with the ticket you are getting meal as well. So airline is never ever showing that this is a meal, this is a air ticket. No, they are asking this is supply of the ticket. So supply of the meal, meal is not basically major component. Ticket is a major principal component. Treatment will based upon the ticket. So the basically single component basically add composite component. Single means principal plus small component. A small component will not be showing as a separate line item on the face of the invoice. Treatment will be based upon the principal component. If there are two components, both are the major components, then the law says we need to show two components separately on the face of the invoice, and we need to treat these are not the composite supply. This is a single supply. We need to assess the treatment of each component individually. But there is a possibility. The possibility is, these two components are being supplied, but these two components are closely linked to each other, but none of them is a principal component. There is a possibility. Then the law says basically, if this is the case, now according to the amendment, the VAT treatment for a single component supply that doesn't include a principal component should be assessed based upon the nature of the whole supply in its all component. We need to assess the nature of the supply. Then we need to decide what is the taxability of that supply. This is the further addition in the law. I believe I believe there is not any major change, because if you are supplying two components, one is a principal component, one is a small component, treatment will be based upon the principal component. If there are two components, none of them is a principal component, we need to assess the two components separately. Okay, then you need to assess the tax separately. We need to show two component, two separate line item on the face of the invoice. In the same way, they are also asking the same thing. We need to assess the nature of the whole supply in its component. Again, while assessing the natures, might be it will come two separate component, might be one principal component. Again, it will not be any major deviation. Again, we need to stick to the basic principal component or two separate component. We need to assess the taxability accordingly. Recovery in respect of exempt supplies. In case of recovery for the exempt supplies, we cannot claim the input tax for the exempt supplies. We know this because input tax is blocked for the exempt supply. For the purpose of input tax recovery and supply the financial services. But now they have added few more services. These are the virtual asset services we need to assess there while claiming the input tax. This is the supply, the financial services. Person is in the UAE, out of the UAE, and this is local supply, export of services. We need to consider all these factors. They further define basically a person to be considered outside the UAE. When a person will be considered out of the UAE, the presence of the person is a short term in the UAE, and short term means less than 1 month. This is not related connection to the supply. These clauses was already part of the public clarification. Now he made a part of the VAT regulations. Basically, if the services are being provided to a person who doesn't have a place of residence or fixed establishment in the UAE, and the person is not in the UAE for person is in the UAE for less than 30 days and not connection related to the connection of services, then it will be considered export of services. But if the person has fixed establishment in the UAE or the place of residence in the UAE or the person is in the UAE for more than 30 days, or the person is in UAE for even a single day, but the person is specifically related to the services that are being provided, then it will not be considered an export of services. It will be considered standard rated services, and you will be able to claim the input tax accordingly. This is the basic addition. They said for the purpose of input tax recovery and the supplies of financial services provided outside UAE, the condition for a person to be considered an outside the UAE, the same condition, even where the person is present in the UAE, are updated where the following two conditions be met. The presence in the short term in the UAE less than 1 month, and this presence is not connected to the supply. If the person is in the UAE for single day related to the supply or more than 30 days, then it will be considered local supply. It will not be considered export, and it will be standard rated supply in the UAE. There no change other than this. Some major amendments are there as well. Article 29, profit margin scheme. What is profit margin scheme? We know that the profit margin scheme can be applied on the second-hand items. Whenever the businesses are buying and selling the goods, they can apply the profit margin scheme. Why this is necessary? This is necessary to remain competitive into the market, because if you are in the market, you are selling your product into the market 100 plus 5%, but your competitor is selling at 100, you will be out of the business. You need to remain competitive into the market. You need to apply the profit margin scheme as well. Once you are applying the profit margin scheme, laws allow you that you cannot claim input tax on the second hand item that you are buying, and you cannot charge output tax on the item that you are selling, but you need to calculate net margin. While calculating the net margin, you need to consider the sales price, purchase price, internal cost, disbursement, and other than third party cost as well. Now the question is that different types of cost, like suppose you are buying one car under the profit margin scheme. Whenever you are buying the car, purchase price will be there, then repair cost will be there, then might be disbursement, registration is there, insurance is there, might be the third party cost, might be you are buying any part from the market and fixing it, third party cost can be there. Now the question is, which costs can become a part of the purchase price? This is important. They have given clarification, but this is not a comprehensive clarification. I just wanted to tell you, disbursement will not become part of the cost. Disbursement will go based upon the standard disbursement principle directly to the customer. So disbursement like motor insurance, because it will be directly in the name of the customer, like registration, it will be directly in the name of the customer. These two items in the case of cost specifically, it will be billed to the customer directly out of the profit margin scheme. Now coming back to the cost. Cost can be of two types, internal cost or external cost. If internal cost, this will already be built in the sale price. So no need to consider the internal cost as well. The third thing is external cost. Now they are asking, if you are buying any item under the profit margin scheme and you are applying the profit margin scheme, whatever is the cost, that your third party cost, you need to include as a part of the cost as well. While applying the profit margin scheme, they said the purchase price shall include, in addition to the purchase of goods, any other cost and fee incurred for purchasing the item. Any other cost or fee incurred for purchasing the item, but you need to include third party cost as well if you have invested on the business on the item. But internal cost will not be part of it. Disbursement will not be part of it. The international transportation, this is again very important clause. Very important clause. International transportation. Suppose one company is in the UAE that is providing only storage services related to the international transportation of the goods. ABC is a company which is providing only storage services, nothing more than this. Another company like DHL is buying the goods from the mainland. From the mainland, they are bringing to the warehouse where they are storing. From the storage, they are bringing to the Dubai airport. From the Dubai airport, they are bringing to the Heathrow. From the Heathrow, they are supplying in the UAE. This is a chain. Now, it was already a silent. It was there no. This clause was not already available into the law. Now they have included it. Basically, now they are asking if any company is providing individual storage services, it will be subject to tax. But if the company is providing end-to-end transportation and in between they are providing the storage services, it will be considered as a part of the international transport. It will be zero rated. What they have written, they said transporting goods from a place in the state to another place in the state. From a place in the state to another place in the state, if services are supplied by the same supplier of the goods, either from a place in the state to a place outside the state, from a place outside the state to a place in the state. These are the basically zero rated category. If you are going back to the Article 33 and reading through, they said if the goods are being supplied from out of the UK to UAE, zero rated. UAE to out of the UAE, zero rated. Any in between transit, zero rated. End-to-end transportation, any services providing in between, zero rated. So they have given further clarification, added new clause. It was not already part of it, but we were already interpreting it accordingly because it has been written in the UK law. It has been written in the KSA law. If one company is providing end-to-end transportation, it will be zero rated. Supplies in between, zero rated. If one company is only providing standalone storage services, it will be subject to tax. This have been clarified. Then Article 34. It has been clarified that the provision of the article supply in addition to supply of means of transport to the important means of transport. Already, I have already explained on the means of transport, we were already applying the reverse charge mechanism, but the logic is very, very clear. The logic is we were always applying the reverse charge by assuming this that we are paying tax on behalf of the non-resident supplier. But if the non-resident supplier would have been supplying the same item in the UAE, it would have been zero rated. Now they're asking while importing, you need to consider as a zero rated supply. They have given further clarification. Annual adjustment where there is exempt supplies, they're asking we need to every month we need to consider how much portion of input tax we need to claim, which we need to block related to the exempt supply. Then by the end of the year, we need to make the annual adjustment. And if the difference in between the input tax that we have blocked and input tax that would have been blocked is more than 250,000, if the difference is more than 250,000, then to make to adjustment. Now they are asking, we need to consider this 250,000 proportionately with the tax year period, which is less than 12 months. Means for the whole year, limit is 250,000. For the less year, it was not already clarified in the law, but now they have clarified 250,000, you need to apply it proportionately. Article 59 of the law. In the Article 59, this is very interesting. That is simplified invoices cannot be issued for supplies taxable under the reverse charge mechanism. Simplified, there is a timeline to issue the tax invoice. The timeline is 14 days to issue the tax invoice. But now they are asking, FT has updated a couple of points under the provision. What are the simplified tax invoices cannot be issued for supplies taxable under the reverse charge mechanism. They are asking you cannot issue the simplified tax invoices if you are applying the reverse charge mechanism. Then they are asking simplified tax invoices needs to be issued on the same date, not within 14 days. Usually, these simplified tax invoices are being issued when the supply is being made to the individual unregistered businesses. So if the supply is being made to the individual, like a restaurant is supplying goods in the market, restaurant is selling food, you are going to the grocery, you are buying anything, they cannot say, you need to come back, we'll give you the invoice after 14 days. No, the law says if you are issuing a simplified invoice, you need to issue on the same day. There is no time limit for 14 days. Then third point, the requirement to issue summary tax invoice same month as date of supply is removed. Now, initially, they said same supplier, same customer, multiple supplies during the whole month. They have right to issue the one tax invoice, which is called summarized tax invoice for the whole month. Now, they said they have given the 14 days to issue the summarized tax invoice as well. The summarized tax invoice can be issued within 14 days following the end of the tax period. For the 1 month, basically, you can issue the summarized tax invoice. This is a alternative available for both issuance and delivery of tax invoice is a very basic thing. You can go through this. Minor amendment is Article 4, minor amendment Article 7, minor amendment Article 16, minor amendment Article 23. Article 27, they have included hotel, apartment, or similar properties. Basically, this is the furnished residential properties which will fall out of the definition of residential properties. So it will be considered hotel, apartment, or similar property. They have added these lines. Article 38, relevant charitable activities has been removed. Article 41, they've added pharmaceutical products and import of pharmaceutical products and import, it will be zero rated. We know this, it will be zero rated. They have further basically regularized it. They have changed the title in case in this article, Article 50, import by unregistered person. The special rules for import. This capital asset scheme, we know this capital asset scheme can be applied where the value of the asset is more than 5 million. And value of the asset for the property is more than 10 million, other than property more than 5 million, asset being used for business purposes. This is called capital asset. And the capital asset, we need to do the monitoring of the capital asset, and we need to claim the input tax on the first year. And then we need to keep monitoring where there is any change in use, we need to adjust the input tax as well. This is the summary of the capital asset. Now they are asking, if you are buying the capital asset, the first year will be considered a time in which you are buying. But if you are developing in-house the capital asset, then the law says the year in which you are starting to use that asset for business purposes, it will be considered the first year. For internal generated asset, first year of use, from that date we will claim input tax and start monitoring. Other than this, whenever we are buying, it will be considered my first year. They further clarified it. Article 60, I think it will be over within 5 minutes. Article 60, agent, sorry, the tax credit note, there is a possibility that one supply, there is a one genuine issue the customer were facing in the market. There is a one supply, against their supply, multiple tax credit notes are being issued. Once the multiple credit notes are being issued, they said you need to mention in the tax invoice original value of original supply, revised supply, difference. On the difference, we need to issue for the difference, we need to issue the tax credit note. Now they said you have issued the first tax credit note. Now after 1 month, 15 days, 2 months, you need to issue the second credit note. Whenever you are issuing the second credit note, so what was the revised supply in the previous credit note, it will become your adjusted value, then again revised value. So I will say just initially, because the value of supply was 100, revised value was assuming 90, the 10 was the difference, you issue a tax credit note for the 10. Again, you are issuing a tax credit note, second credit note. In the second credit note, adjusted value will become 90. Then revised value will become 80. Then difference, you need to issue a tax credit note on 10. This thing they are asking where the registrant issued more than one tax credit note in relation to the same tax invoice, it is clarified that the value of the supply in respect of subsequent tax period shall be the adjusted value based on the previous tax credit note. I think everybody is clear regarding this. Then for the if the agent is issuing a tax invoice on behalf of the principal, disclosed agent is there issuing a tax credit note on behalf of the principal, is required to meet the following conditions. What are those conditions? Agent maintains sufficient record to determine the name, address, and TRN number of the principal, and the principal needs to maintain a record to name, address, and TRN number of the agent. This is the requirement, record maintaining requirement that you need to maintain it. Minor amendment article 64, you can go through this, but no changes in the overall meaning of the article. Minor amendment article 65, no change in the meaning. Minor amendment article 68, they have removed 3 months to 90 days. Overall meaning of the articles are same. The provision is amended timeline for claiming refund by foreign government entities. They said foreign government, they have put a cap and they can claim maximum within 36 months from the date of the official supply. They need to claim the input tax. They would put the timeline. And the minor amendment on Article 71 without any further change. This is over from our side. Thank you very much. I really appreciate your support. If you have any question, you are most welcome. Otherwise, you can drop us an email. 6 questions are there. Let me go through this quickly. What are those 6 questions? I'm not able to open the questions, unfortunately. Might be Faiza. Have you already replied these questions?
No.
I'm trying to open these questions, and can you check it? Might be you will be able to open it.
Okay.
These are not popping up on my screen.
Yes, I can see the question. If you want, I can share the screen.
Yeah, can you share the screen, please? Quickly, we can go through this.
Yeah, I can make
Giving
me
you the
host.
admin rights. Yeah, by the way, these are coming here as well. Sorry. So the first question is, Huma is asking, If services provided to foreign company performed on goods sold in UAE like marketing, will it be VATable services? If you are performing the services, this is the one very debatable thing in the market, but we always advise to the client the performance of the services in the UAE, it should be subject to tax in the UAE, because this is the performance of the services, specifically location related services. So these are not audit services, accounting services, these are location related services. Specifically, you need to perform the services related to the specific place, then it should be subject to tax in the UAE. But these are generic services, like you are sitting there, you are designing flyer, brochure for a customer out of the UAE. These are not location specific services, then it should be zero rated. For a customer who doesn't have a place of residence, who doesn't have a fixed establishment, who is not in the UAE for more than 30 days, then it will be considered zero rated supply. Hussain is asking, I believe interpretation of Article 31 newly added clause is a bit different. It will establish that the place of supply of a certain services is not UAE. UAE 5%, 0% should not be applicable. No, basically, if you are going in the law, it has been written somewhere, arranging of the services is zero rated. If you are based in the UAE and you are arranging the services by being based in the UAE, should be zero rated. Does cruise vessels covered under means of transport? If yes, whether these are not considered for recreational purposes and cannot be treated zero rate, please confirm. Listen, the means of supply are ship, transport, ship, aircraft, vessels, boats that are being used and adapted to use for the transportation of goods and passenger, not recreational. If recreational purposes, straightforward, subject to tax. Other than recreational purposes, then it will be the supply will be zero rated, and services out the any services directly related to the means of transport, still it will be zero rated. Abdul Qayyum is asking how overseas company can claim 5% VAT if charged by UAE associate company due to attending the conference in the UAE. Conference are being arranged by USA company for the overseas associate company. Okay, conference place of supply is where the conference is being held. If conference is in the UAE, place of supply will be UAE, 5% tax will be applicable. Now you need to look into this. Is this your business expense or your company business expense? If this is your business expense, you have right to claim 5%. If this is not your business expense, you need to claim 5%, then you need to charge 5% to your company which is outside the UAE, or you can, without claiming 5% VAT, you can pass on the invoice directly to them. It will be at the end cost for them, and 5% will block in their books because this is not your business expense. Medical insurance for dependents. Medical insurance for dependents, they said this is a legal obligation for the, I think this clause was there as well. Somehow I forgot it. So medical insurance is, they said if this is a legal obligation, the employee, spouse, and 3 kids having a age less than 18, you have a right to claim input tax. Otherwise, you cannot claim input tax. Legal obligation should be there. Jawad is asking, can we have these slides, please? Okay, please share your email. I'll send it to you. Another question, in case of providing transport services to foreigner with respect to goods imported to UAE to be delivered on mainland address, will it be zero rated even if shipment charges have been separately charged as local transport? No. If you are providing local passenger transport, exempt. Local goods transport, it doesn't matter wherever is the customer, standard rated. End-to-end transportation by the company like DHL, then it will be zero rated. Can we have these slide I'll share? Please send me your email address. Can you elaborate the condition which needs to be met for voluntary registration? Voluntary registration within the last 30 days, taxable supply should be a taxable expenses more than $50,000, and the next 30 days, 50,000 or 50,000 taxable supply year expenses. You must have the documents which show that your taxable expenses will be more than $50,000 or taxable supply will be more than $50,000. Then you can apply for voluntary registration. Otherwise, you cannot apply. Is there any input tax which can be claimed against the output tax? Is there any input tax which can be claimed against the output tax? I didn't get it. Apologies for this. Just drop me an email. What will be the FTA stand where cruise vessel will be treated recreational? FTA stand recreational, straightforward, subject to tax, not zero rated supply. If an entity providing the transportation services from port to FZ and FZ to port, will it be zero rated? No, it will be standard rated. Since we are operating in Oman, there the cruise is considered a recreational purpose and it is a standard rated supply. Yes, it will be standard rated supply. What is the process to claim 5% by overseas entities? You need to get yourself registered in the UAE for VAT purposes. Then you have a right to claim input tax. Okay, guys, thank you very much. Thank you very much for being with us and have a lovely evening. See you again after 1 week. Have a good day. Thank you. Thank you very
Thank
much,
you,
Faisal.
everyone. Bye-bye.
Thank you. Bye bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.